Stop scrolling. Put the phone down for a second. Close the extra tabs, because what's happening right now in gold and silver could be the difference between positioning early and later explaining why you missed it. Most people misread quiet markets. When comment sections go silent, when silver stops trending, when the to the moon crowd disappears, it feels like the rally died. But silence in a bull market isn't death, it's loading. Today is February 19th, 2026. Silver is sitting around $78. Gold is holding above $5,300. Beneath that calm surface, multiple signals are aligning at the same time: technical, institutional, macro, structural, and psychological. Individually, each one matters. Together, they form a powerful accumulation setup. Let's start with the chart. On January 29th, silver printed an all-time high near $121. The next day brought a violent crash. Silver opened above 115 and collapsed intraday into the 70s on massive volume. That was emotional buying meeting forced liquidation. That was tourists entering at peak excitement. Then came a deeper flush into the low 60s in early February. But instead of collapsing further, price reversed hard within the same session. Physical buyers stepped in aggressively. It didn't grind higher slowly, it snapped higher. After that, we saw another push down into the mid-70s. This time, volume was significantly lower. Sellers came back with less force and did less damage. That's exhaustion. When price revisits similar levels on shrinking volume, it signals a transfer of ownership. Weak hands exit, strong hands accumulate. And this structure, higher lows with declining sell volume, has preceded many major commodity breakouts in the past. It's boring by design. Institutions accumulate during boredom. Retail chases during excitement. Right now, this market is boring. That's the point. During the January spike, dealers were overwhelmed. Shipping delays expanded. Premiums surged. Inventory disappeared quickly. That wasn't stable demand. That was emotional demand. Now shipping times have normalized, premiums have compressed, and supply chains are functioning smoothly. Retail interprets that as fading demand. Professionals interpret it as the crowd clearing out. Large institutions don't build serious positions during retail panic. They wait for calm. Calm creates opportunity. Meanwhile, major financial institutions have published year-end gold targets well above current prices. Not social media predictions, formal research notes. When large banks publish conservative targets with language like upside risk, they are signaling positioning, not hype. They need entry points, and entry points require consolidation. Media negativity is also returning during this pullback phase. Historically, narrative pressure during corrections often coincides with mid-cycle consolidation rather than long-term tops. Sentiment weakens before structure breaks. Right now, sentiment is cooling, but structure remains intact. On the supply side, silver has been running structural deficits for years. Industrial demand from solar, electrification, and advanced infrastructure continues expanding. Exchange inventories remain significantly lower than they were in 2020. Physical tightness doesn't always show up immediately in price. It shows up first in volatility and sudden reversals. Central banks have also been accumulating gold at historically elevated levels since 2022. That isn't speculation. That's reserve management. When sovereign institutions diversify reserves, they move quietly. That behavior hasn't reversed. The strongest signal right now isn't price. It's psychology. Investors who bought near $120 feel frustrated. Investors who stayed out feel validated and are waiting for even lower prices. Forums are quieter. Conviction sounds softer. That emotional mix, doubt among bulls and confidence among skeptics, is typical near structural bases, not euphoric tops. Real tops are loud. Bases are quiet and uncomfortable. For years, the argument against precious metals was yield. Gold doesn't pay anything. That argument works best in stable currency environments. When fiscal deficits expand and long-term purchasing power questions grow, the no-yield argument weakens. Capital begins looking for constraint. Metals are constrained by physical supply. Fiat supply is policy-driven. That difference becomes more important over time. The key levels now are clear. The low 60s represent proven deep support. The mid 70s represent the higher low structure holding the pattern together. The mid to high 80s represent the breakout zone. A sustained move above that upper range on expanding volume would signal the end of compression. Until then, this is consolidation territory, not euphoria territory. If you hold physical metal, the broader thesis hasn't structurally changed. If you use leverage, risk management is critical. If you are unpositioned, understand that the window that feels boring is often the one people later wish they had used. Markets do not reward comfort, they reward preparation. Right now, nothing feels exciting. That is usually when positioning happens quietly, because when momentum returns, it rarely gives long, calm entry opportunities. The silence many mistake for weakness today may eventually look like the final stage of accumulation. Stay disciplined. Watch structure over noise. Position strategically.